Imagine this. The world's financial system, built on endless paper promises, is suddenly confronted with a simple, undeniable reality. There isn't enough physical silver to go around. Banks are scrambling. Exchanges are seizing up. And the price? It's exploding higher as we speak. As of December 16th, 2025, silver is trading at approximately $63 per ounce, having more than doubled in value this year alone, posting gains of over 110% year to date. That's not hype. That's fact. But here's the question that should keep every investor, every central banker, and every industrial buyer awake at night. What happens when the physical metal simply runs out? Are we on the verge of the biggest silver squeeze in history, one that could propel prices to $100 an ounce or beyond? Welcome to this in-depth presentation on Silver Squeeze 2025. Banks can't find metal. $100 coming? Today, we're going to examine the hard data, the structural realities, and the unmistakable signals from the latest market developments that suggest silver is entering uncharted territory. This is not speculation. This is analysis grounded in real-time facts. Stay with me as we break it all down, step by careful step. Let's begin with the explosive price action of 2025. Silver started the year in the low 30s. By mid-year, it had broken above $40. Then, in the fall and winter, momentum went parabolic. October and November saw violent spikes, with prices surging past $50, then $60, and recently hitting all-time highs above $64 per ounce, before a slight pullback to current levels around $63. According to the latest data from major exchanges and tracking services, silver has delivered gains exceeding 110% year-to-date, dramatically outperforming gold's already strong performance. The gold-to-silver ratio has compressed sharply from over 90 to 1 earlier in the year to around 68 to 1 now, one of the lowest levels since 2021. Why does this matter? Historically, when silver outperforms gold this aggressively and the ratio compresses, it signals a shift driven by physical scarcity, not just monetary flows. Now, the foundation of this move, a multi-year structural deficit. The Silver Institute and leading analysts confirm the global silver market is in its 5th consecutive year of supply deficit in 2025, with shortfalls ranging from 95 to 149 million ounces depending on final projections. Cumulative deficits since 2021 approach 800 million ounces, nearly a full year of global mine production. Demand remains robust at around 1.2 billion ounces annually, overwhelmingly driven by industrial uses. Over half of all silver consumed now goes to fabrication in solar panels, electric vehicles, electronics, 5G, and increasingly AI data centers. Photovoltaic demand hit records again in 2025, with solar alone consuming over 200 million ounces. Electric vehicle silver usage continues climbing, with each EVI requiring 1 to 2 ounces, far more than traditional vehicles. And AI infrastructure? Data centers demand massive conductive efficiency, where silver's unmatched properties shine. Mine production? Essentially flat, around 813 to 835 million ounces, with no major new sources coming online soon. Recycling helps, but falls short. The result? Relentless drawdowns from above-ground stocks. This brings us to the physical tightness, the core of the squeeze. Recent reports highlight extreme stress, lease rates spiking, backwardation in futures, and massive delivery volumes. In early December 2025, over 60% of registered COMEX silver inventories were claimed in just the first few trading days, an extraordinary rate signaling entities demanding real metal. London vaults remained critically low after earlier drains, while COMEX has seen record inventories at times, but also rapid outflows during delivery months. Physical premiums on bars, coins, and rounds have surged, with delays reported for immediate delivery. Refiners and dealers confirm paper silver is plentiful, but physical, at spot or near spot, is increasingly hard to source. The COMEX paper market trades volumes 100 times annual mine supply, mostly cash settled. But when physical buyers, industry, sovereigns, institutions stand for delivery, even a fraction can strain registered stocks. 2025 has seen record delivery months, elevated open interest, and warnings of potential commercial signal failure, where futures no longer reflect physical reality. This time, pressure comes from sustained industrial and investment demand, not just retail. Let's dive deeper into that unstoppable industrial force. Solar. Every panel needs silver paste. Global renewable targets drive record demand over 200 million ounces in recent years. Electric vehicles. Surging adoption means steady growth in automotive silver, now a major category. Electronics and 5G, irreplaceable connectivity. Artificial intelligence. Exploding data center build-outs require vast electrical infrastructure. Silver delivers efficiency. No scalable substitutes exist. Thrifting has limits. Industry bids whatever is needed. adding tailwinds, central bank diversification, strong ETF inflows, U.S. critical minerals, designation opening potential strategic actions, and macro uncertainties driving safe haven demand. Silver's dual role, monetary and industrial, gives it leveraged upside. Where does price go next? Analysts have raised targets, some to $65 near term, bullish voices to $80 to $100 in 2026 or sooner amid ongoing tightness. Math supports it. Persistent 100+ million ounce deficits ration via higher prices. Historical squeezes show rapid detachments. A $100 target from $63 represents about 60% upside, achievable if conditions persist, given 2025's 110% plus gain. Risks: economic slowdown tempering industry, policy shifts. But structural trends are secular, multi-year. For investors, distinguish paper from physical, own metal for scarcity protection. Silver remains undervalued relative to gold historically. Monitor inventories, deliveries, premiums. We stand at an inflection point. Persistent deficits, surging demand, tightening supply collide with leveraged paper markets. Banks, exchanges, industries compete for limited ounces. Global mine production in 2025 is estimated at around 813 to 835 million ounces, essentially flat year over year, with some projections showing slight declines in primary silver output. Silver is predominantly a byproduct of mining other metals like lead, zinc, copper, and gold. Over 70% of annual supply comes as a secondary credit from these operations. When base metal prices soften or mines age and deplete, silver output suffers indirectly. Major producers in Mexico, Peru, and China, the top three nations accounting for nearly half of global supply, face maturing ore bodies, higher costs, permitting delays, and in some cases, community or regulatory challenges. No transformative new primary silver mines are slated to come online in the near term. Projects take 10 to 15 years from discovery to production, and exploration budgets have lagged for years due to historically low prices discouraging investment. Recycling provides a buffer, projected around 195 to 200 million ounces in 2025, but even here growth is limited by collection efficiencies and the fact that much industrial silver ends up in dispersed applications like electronics, where recovery rates are low. The net result? Total supply struggles to exceed 1 billion ounces annually, while demand consistently pushes toward 1.2 billion. This mismatch has created cumulative deficits approaching 800 million ounces since 2021, equivalent to nearly a full year's mine production drained from above-ground stocks. Those stocks, once vast, are no longer the infinite buffer they appeared to be. Institutional and governmental holdings have been drawn down quietly over decades, leaving less slack to absorb modern industrial surges. Now, historical parallels. We've seen squeezes before, but nothing quite matches today's scale. Consider the Hunt brothers' cornering attempt in 1980, which drove prices to $50 nominally, over $200 in today's dollars, but that was largely speculative, fueled by leveraged positions, and ultimately collapsed when regulations changed. Palladium in 2021 offers a closer analog: structural deficits from automotive catalysts, combined with Russian supply risks, propelled prices from $1,000 to over $3,000 in months, a 200% gain. Nickel in 2022 saw an epic short squeeze on the LME, with prices spiking 250% intraday due to physical delivery pressures. But silver today combines elements of both: relentless industrial bidding akin to palladium, overlaid with potential paper market dislocations like nickel. The key difference? Silver's demand is secular and accelerating, tied to irreversible trends like decarbonization and digitalization, while supply elasticity remains near zero. In 2021, the Wall Street silver retail movement exposed COMEX leverage and drove temporary premiums, but industrial buyers were not yet at peak intensity. Now, with solar alone consuming over 200 million ounces annually, EVs adding tens of millions more, and AI data centers emerging as a new wildcard, requiring vast conductive infrastructure, the pressure is broader, deeper, and more sustained. Lease rates spiking to extremes, backwardation persisting, and delivery volumes shattering records all echo these past events, but on a larger canvas. Advanced strategies: how to position ahead of potential $100 silver and beyond. For conservative investors, core holdings in physical metal, 1,000-ounce bars for efficiency, or government-minted coins like American Eagles, Canadian Maple Leafs, or British Britannias for liquidity and recognizability. Thanks for watching.